This is LBO Transaction Hilton, presented by Group 4 Jessica Lee, Luis Eduardo Torres, Amy Tran, and Edwin Wall.
Blackstone and Hilton began negotiations in 2007, and Hilton went private for $26.1 billion when Blackstone agreed to pay $47.50 a share for Hilton. The merger was announced on July 3, 2007.
The period between 2005 and 2007 was something of a buyout boom for Blackstone, with 10 major acquisitions before Hilton, all of them consisting of LBO transactions. The month before purchasing Hilton, Blackstone launched its own IPO and raised over $4 billion in cash, which was used to partially finance the Hilton acquisition. From 2004 to 2007, Blackstone spent approximately $15 billion acquiring hotel companies.
Hilton Hotels was founded by Conrad Hilton in 1919. It became the first coast-to-coast hotel group in 1943. It became the first hotel company to be listed in NYCA in 1946. Hilton Hotels was the largest group of hotels in the world, which include more than 2,800 hotels and 480,000 guest rooms in 76 countries and territories. By 1964, Hilton formed a separate company, Hilton International, but just 2 years later, Transworld Airlines acquired the international entity. Hilton opened DoubleTree franchise in 1969, Embassy Suites and Hampton Inn in 1984, and Hilton Garden Inn in 1990. Hilton Corporation acquired Hilton International in 2006. By 2007, Hilton Corporation merged with an affiliate of the Blackstone Group. Blackstone was founded in 1985 as a mergers and acquisition boutique by Peter G. Peterson and Stephen A. Schwarzman, who had previously worked together at Lehman Brothers, Kuhn, and Loeb Inc. It specialized in private equity, credit, and hedge fund investment strategies, as well as financial advisory services such as mergers and acquisitions, restructuring, and reorganizations and private placements. Blackstone has completed investments in such notable companies as the Hilton Worldwide, Equity Office Properties, Republic Services, Allied Barton, United Biscuits, Freescale Semiconductor, Vivid, and Travelport.
The marriage between Blackstone and Hilton deal combined two powerhouse lodging portfolio, and as a result, Blackstone became the world's largest hotel owners in 2007. Prior to purchasing Hilton, from year 2004 to 2007, Blackstone invested roughly $17 billion in hotel companies. In 2004, Blackstone acquired Prime Hospitality Corp and Extended Stay America. This began a series of acquisitions in the hospitality industry. Blackstone's next major hotel purchase was an acquisition of La Quinta Inns and Suites in January 2006. The private equity firm also owned high-end properties as LXR Luxury Resorts and Hotel, in which it invested $1 billion in redevelopment capital during the past 3 years, in 2004 to 2007. Blackstone saw a significant investment in the real estate industry, which was seemingly booming in the summer of 2007, and by then Blackstone owned more than 100,000 hotel rooms in the United States and Europe. Blackstone Group was the major fund participant since Hilton Hotel agreed to an all-cash buyout from the Blackstone Group. In the acquisition announcement, Blackstone said it intended to invest in Hilton and grow the business for the benefit of owners, franchisees, and customers.
Financing for this transaction was provided by 7 different banks in a consortium. This consortium included membership of Bear Stearns, Bank of America, Deutsche Bank, Morgan Stanley, Lehman Brothers, and Goldman Sachs. All of these were entities that had also served as financial advisors to Blackstone in the past. This was an all-cash transaction, and Blackstone spent $5.2 billion of its existing capital to buy a pure equity stake in Hilton. The consortium supplied the remainder of the money, buying both debt and equity in Hilton. Please look at the chart to the right for more specifics on the proposal and sources of funds exactly required for the transaction.
Hilton's stock price before Blackstone made the announcement about the acquisition was $29.96 a share. The deal's total value was $26 billion including debt. Blackstone combined cash from its real estate and corporate private equity funds to buy all of the outstanding Hilton shares at $47.50 a share, which was an acquisition premium of 36.91%. The deal included the assumption of Hilton's debt, which at the time was more than $7 billion. On the right, you'll see the transaction multiples between Hilton and Hilton's peers for this particular deal. I'd like to draw your attention particularly to the debt to total enterprise value ratio. This is the indicator of how much debt Hilton had relative to its equity. It's 28.34%, which is represented by the $7 billion. The equity, which the remainder of the deal was used to finance, was 71.66%, indicating that Hilton was comprised primarily of equity at the time of the transaction.
Blackstone announced that it was acquiring Hilton on July 3, 2007, which caused a jump in Hilton's stock price. Hilton's stock price is represented by the green line, and it jumped to a level of around $45 a share following the announcement, where it hovered until the deal's completion on October 27, 2007, at which time Blackstone sold its share in Hilton for $47.48.
For this LBO deal, there weren't very many issues in regards to regulation dispute or legal issues for Blackstone to acquire Hilton Hotels. However, in 2009, Starwood Hotels sued Hilton Hotels for corporate espionage, claiming that Klein and Lavani, two former Starwood executives, stole more than 100,000 documents containing Starwood's competitive sensitive information when they joined Hilton. In 2010, the legal settlement determined three things. First, Hilton had to pay $75 million to Starwood. Second, they prohibited to introduce any lifestyle hotels for 2 years. And lastly, Hilton is under supervision to make sure they're operating under compliance. The next thing to discuss is the tax implications for this deal. The taxes were rather significant because revenues from 2006 to 2007 had increased by 33% as a result of the acquisition of Hilton Hotels. With such a huge boost in earnings, the taxable income consequently increased as well. As for accounting issues, Blackstone did not show any difficulties when filing with the SEC. The annual 10-K filing under Item 9 indicated that there were no changes or disagreements with the accounting disclosures regarding the way Blackstone had accounted for Hilton transaction on their books. The public accounting firm Deloitte & Touche audited their financial statements and issued an opinion that everything was presented fairly in all material respects.
There were several unique aspects to Blackstone's acquisition of Hilton in 2007. First, the acquisition marked the largest hotel buyout in history, and it was a huge transaction just before the financial crisis of 2008. Bear Stearns and Lehman Brothers each had significant holdings in this transaction. While Lehman Brothers never disclosed the precise amount that it held in the transaction, Bear Stearns, after filing for bankruptcy, passed along a $4 billion debt, a piece of the transaction, to J.P. Morgan Chase. In the financial crisis, Blackstone's investment in Hilton lost 70% of its value. This loss happened in 2 years, 2008 and 2009. The reason for this immense loss of value was primarily because Hilton, as a hotel, had enormous holdings in real estate. The rapid loss of real estate's value hit Hilton hard. Today, 5 years later, Hilton has a positive NAV for the firm. So far, however, because of the gigantic losses incurred in 2008 and 2009, the investment has been neutral for Blackstone, rather than a victory or a defeat. Blackstone's acquisition of Hilton Hotels in 2007 at first appeared to be a disastrous mistake in the subsequent financial crisis of 2008. Since 2008, real estate has recovered significantly, and because Hilton's underlying business has remained strong, Blackstone is currently planning for an IPO of the company and expects good results. Hilton has filed to raise as much as $1.25 billion when it goes public, and before the IPO, Blackstone plans to refinance $13 billion of Hilton's debt. In July 2013, Blackstone also filed plans to sell its shares in a number of other companies. First, the Extended Stay America hotel operator, which has an equity value of between $3 billion and $4 billion. Additionally, it plans to sell its stake in La Quinta Hotels for $4.5 billion. It's especially interesting to note that Blackstone's sale of Extended Stay America does not realize a substantial profit for the company. This indicates that Blackstone is either getting out from underneath the investment or planning to raise cash for an investment purpose in the near future.